With the headlines and market reactions giving some investors heartburn, I'm happy to welcome Craig Basinger, Chief Market Strategist at Purpose Investments. Craig manages, amongst others, the core equity income and the tactical asset allocation funds that most of you hold in your portfolios. And he's also the former CIO at Richardson Wealth and has more than 25 years of experience managing portfolios and bringing to the table not only his experience in fundamental and quantitative research, but his background in psychology. So he's here today to provide some insights on the market turbulence of the last couple of weeks, and I'm hoping some expectations for going forward. So my first question, Craig, is, have we seen peak uncertainty?
We've been doing a lot of these of late because from a behavioral perspective, this is clearly our busy time when markets become somewhat, let's just say, unhinged. I do think we may have passed peak tariff uncertainty.
Okay.
And I say that with the full acknowledgement that nobody has a clue, including even the US administration, where this sort of middles out or settles down or ends, or when it ends. But I will say I have a very hard time envisioning a scenario that is more market unsettling than President Trump with his little fancy billboard graphic of country flags and tariffs, immediately followed by many of those countries the next day talking about the tariffs they were going to put back on the US, and then the US ratcheting their tariffs up. And I'm not 100% sure, but I don't think there's been $1 paid in tariffs yet. And I could be wrong on that, but it's, and I totally get, for the longest time this year, even at the beginning of this year, the optimism was, okay, yeah, this is all uncertain, all talk. They'll find some sort of off-ramp, middle ground, something that is, changes the landscape a bit, but, is more tenable or manageable. And then I think on that Rose Garden Day, that sort of was thrown out the window. But as we've sort of talked about this before, it's being called the Trump put, meaning if things get bad enough, they pivot, and that's clearly what happened. And we had, obviously the markets have partially recovered since then with this sort of 90-day pause. So I think the max uncertainty on tariffs is probably behind us, and that's from a market perspective, not from an actual where we end up. So I think that's somewhat good news.
Okay. So one of the things, though, it was that Trump's policy, and I use that term lightly, was tariffs and tax cuts. There's been a lot of talk about the tariffs and less talk about the tax cuts. Are we forgetting about it? Do you expect tax cut announcements to come, and what kind of impact would that have?
Yeah, you're right. I mean, when initially elected, there's a number of different things that they said they were going to do, or they were going to address, or different things. And some of them were tariffs was obviously the market unfriendly one, and other ones were more market friendly, more on the deregulation side, tax cuts, that type of thing. And we've seen obviously in the market reacted positively out of the gate, and then all we've heard so far is the negative, whether it's Doge and layoffs at the government level or tariffs. I think they're coming. I think they're probably going to end up getting them through. I think I think one of the reasons they did this 90-day pause is because this is the window where it's probably going to be easiest for them to enact some tax cuts. Okay. Right now, the U.S. government isn't issuing a lot of debt because they're getting tax receipts in and they're bringing down the general account. That's just tends to be an easier time. So I think you could probably see something in that area. I don't know if that'll be as big a positive as people think. Listen, tax cuts are great. Don't get me wrong. We all pay too much in tax, and everybody likes those ideas. I don't know if the market's going to overly react positively to that. So I think the less uncertainty on tariffs is probably the bigger positive at this point.
Okay. Can you talk about the ownership of U.S. Treasuries and how is that playing into the tariff story?
Yeah, there's like there's a lot of people who are getting a little bent out of shape about, oh, what if this devolves further with China? Are they going to start selling more of their treasuries? Is Europe doesn't like America anymore, so are they going to stop, are they going to start to sell and what have you in different areas like that? And I get it. And like during those worst days in early April when the market was down and bond yields started rising up, that was part of the narrative that was bouncing around. I'm not sure that was accurate. I think it was probably more, there was a massive amount of different investors removing leverage from the system, and that caused the bond market to behave in a weird way for a couple of days. The fact is, a lot of these countries own treasuries not because it's an active decision to own treasuries. It's simply because that's how global trade works. So, and as an example, Chinese exporter sends a shipment of goods over to America. America pays for them in US dollars. The exporter from China then has US dollars that they deposited into their bank, and that filters up to the central bank in China, which they can then flip over, or they can just keep them in US dollars and put them into treasuries. So that's why China has so many treasuries. Like they didn't make an active decision to say we're going to diversify our reserves into US treasuries. It's because of global trade. Now, tariffs might lower global trade, which would reduce demand, this natural demand for US treasuries, and that's a bit of a concern. But it's also important, like there's so many different core buyers of treasuries that getting excited about China, and don't get me wrong, like if China went out tomorrow and said, we're going to sell all our treasuries, yeah, that's a fundamental problem. I don't think they would do that, but that would be a problem. But there are so many different buyers of treasuries across the board, whether it's endowment pension funds, institutions, banks on their reserve side, domestic banks, that is, and other central banks. I just have a hard time getting really excited about these kind of theories where it's like, oh no, they're going to dump the treasuries and that's going to mess up the treasury market. I get some of these things happen on the margin, but I'm not convinced that's something that's going to become a problem.
Okay, so going further down the rabbit hole of conspiracy theories.
Yeah. Well, don't go on Zero Hedge in case you're wondering where people get all these ideas. But anyway, sorry, go ahead.
Well, I was going to talk about Truth Social. Yeah, and what do you make of the market manipulation and Trump enriching his inner circle through tweeting on Truth Social. What do you think's behind that? How much more do we expect to see of that? Yeah, I don't know. Can you comment?
Yeah, not really, because who knows, right? What is the theory that they're trading these things and then making these announcements? I mean, maybe.
You're not that much of a narcissist?
I mean, like, listen, anything's possible, but it just, I don't think that's the case. Because I think if that were truly the case, like somebody in close enough to that circle would become a whistleblower and really put it out there beyond the conspiracy theories of like, this sounds like market manipulation. I mean, I could be wrong, but yeah, and fretting over it, I'm not sure what the benefit would be. It would just be another reason to become more unhappy.
But should we all get True Social accounts so we know when the next one's coming?
Yeah, I don't know if it'd be quick enough. And the other thing is like, I think this is a really unique period. I am longer term, my mindset and experience has been policy is not the most important thing. Okay. It probably is right now. So I'll take a step back and say, yeah, in the US with the uncertainty around tariffs, policy might be the most important thing right now. And in which case a tweet or a Truth Social post can change the market dynamic from one day to the next. But generally, policy is much slower in actually having an impact, it's very hard to like figure out if this policy announcement results in a positive or negative near-term market impact. Right now it is. I think that will pass. And I also think, our view is like we've got this stabilization that we're experiencing right now because we've passed the peak tariff uncertainty. I think the bigger problem is what happens to where are earnings going to go, and is this going to start to creep into the real economic data? Like we all know sentiment's really bad because we keep getting punched in the face with all these headlines. But does it start to creep into the harder economic data? And so far it hasn't. So people are unhappy, but they're still getting on those planes and they're still doing business. If that starts to change, then all of a sudden a tweet can't fix that.
Okay.
But
that's timely, or sort of good lead into my next question, which is I have read that some people are asserting that the U.S. economy is strong enough to withstand sort of damage from his trade policy, and so it may not be as recessionary as we might anticipate. Thoughts?
Yeah, so I agree.
Okay.
The U.S. economy is fundamentally on a pretty sound footing and can probably absorb a lot of negative policy shocks, which is what we would call these.
Okay.
I would also say, like, the hardest part about policy, that's why I never wanted to become a central banker, is like, you have to make these policy decisions, and this includes tariffs, and you might actually be making the right decision, but we won't know for 2 years, 3 years, 4 years. And that becomes a very challenging environment to actually make decisions in, when your feedback loop on whether you passed or failed or made the right choice or wrong choice, you may learn about it when you actually don't even have that job anymore. And that's what makes all these very difficult. Now, I will adamantly disagree with the approach they're taking on a number of different, and their approaches to many of these different things. But addressing the trade issue at its core is not a bad idea, I think, from the U.S. perspective. And so I agree with the part of the essence of what maybe they're trying to do. I completely disagree with their method of doing it. But again, we won't find out if this is actually right or wrong for many, many years. Now, on the economy side, I mean, employment is good, wages are good, debt levels are manageable at the consumer level, maybe not the government. That's a bit of another story. But I would even go one step further. It looks more and more like China will actually start adding stimulus focused on their consumer, not the kind of China stimulus that we love here in Canada, which is when they buy steel and copper and stuff that we make. But nonetheless, they are going to probably be adding more stimulus in this, in part because of this conflict, but in part because they're kind of long overdue. And I would also point out, Europe is in a very interesting situation. Like Europe has been much more fiscally restrained over the last couple of years, where the U.S. has been very spendy from a government perspective, and that's what's helped the U.S. economy considerably over the last few years relative to others. But Europe's actually starting to pivot now, and they're actually starting to spend more on the fiscal side. And at the same time, their consumer is in really good shape, because whether it's because of their leaders or not, but they haven't been spending over the last couple of years. So the consumer balance sheet in Europe is really strong. So, you've got these other counter components that I think would help balance out or mitigate the risk of any sort of global recession, even with all these bad policies that are going to elevate that risk. So I do think later this year we get a bit of a recession scare. We've gotten little whispers of it now, but it's not in any of the data. So I think when it starts to creep into the data, people get a bit more excited. And I think that may create, some sort of buying opportunity. But I think given the strength and given those positive dimensions, I don't think it's going to develop into something, nefarious.
So then you've talked U.S. and Europe potential recession or evasion. Goldie Hyder, CEO of the Business Council of Canada, suggested that eliminating our interprovincial trade barriers could have as much as a 4% positive impact to Canada's GDP. Do you agree with that, or that how much of a pop could it provide? And do you see a real momentum for, I mean, Doug Ford made an announcement yesterday, right? So can enough be done in a short time frame to mitigate the impact of tariffs for Canadians and avoid a recession here?
No, on the mitigating tariff side. So listen, we should have gotten rid of interprovincial tariffs long ago and trade restrictions. It's absurd. And this is all right. This is one of the positive aspects about Trump. He's literally kicked everybody in the butt, and a lot of these governments are now, pushing the politics aside and like starting to address some of these problems that should have been addressed long ago. So I think that's actually a bit of a positive. I don't think there's enough East and West kind of trade to actually mitigate our southbound trade. So by any stretch. So I think it would be positive, it would be good news, but yeah, we just trade too much with the US. And I think over time, like, hopefully we readdress that and start finding additional buyers and do more east-west. And when I say east-west, I'm also talking about off the coast of east and off the coast of west. And because I think that's probably the better approach to take. But we're too tied to the US at this point, where I think that would mitigate it, but I don't think that would mitigate it nearly to the same magnitude of what we would be losing. Again, if how these tariffs roll out, which again, we don't know. And right. I don't know if I buy the 4% number, but I'm not going to dig deep enough into the numbers on that.
Fair. And in terms of the, how these tariffs play out, I think there's a lot of thought that we're not going to wind up with 25% tariffs across the board. There's already hints that Trump and Carney are going to, Trump and the new prime minister
potentially,
will be able to negotiate something after our election.
Yeah. Now that we know who Joelle is voting for, just kidding.
I'm staying neutral.
I know. You're in a city. It's best you should.
Yeah. So I guess fundamentally the question is, I think people are looking to have answered, is when might we see more stability? And part two of that question is, how can investors stay focused and adapt effectively? And or the other sort of adage I've heard is, in chaos, nobody knows what the answers are, and sometimes doing nothing is the best course of action.
Yeah, I mean, I would take, well, maybe. Listen, investing is an uncertain operation, is what it is. It's dealing with uncertainty, and uncertainty is certainly elevated right now, and that's what markets are reacting to. During times like these, your greatest risk is making a behavioral mistake and reacting with more emotion and letting the headlines really beat you down or lift you up in other previous years. Just in case we forgot those previous years, it was those last few. It wasn't that long ago. And so, avoiding those emotional aspects, I think, is crucial. But I would also say it's when there is more chaos and more uncertainty is very often very opportunistic. And from our vantage point, from sort of a portfolio construction perspective, we came into this year decently defensive and good amount of international and other components that have worked out quite well. And at the beginning of this year, when the S&P was 6,000 and we were underweight US, our view was, hey, listen, if it gets down to 5,500, we'll probably buy some, and we did, and that's early because it's below 5,500 right now. In case anybody doesn't have their Yahoo Finance open in front of them, and our view was we would probably be more, we would probably do more buying if we got down to 48 or 4,700. Now, I'm not saying it's going down there by any stretch. I'm just saying when there's uncertainty, and we can call it chaos if you want, but I'm just going to call it uncertainty. It sounds more amenable. The one thing that reduces risk is a lower price point.
Right.
And if you can buy things at a lower price point, even when you do not know what's going to happen, because you never will, if you wait around until everything's resolved, that price point won't exist anymore.
Yep.
And so that's what is probably the hardest part of investing. But
so let me ask, going more onto your psychology background, why are people so willing to buy tuna when it's on sale? You know, they stock up and they've got 6 cans or a dozen cans in their pantry. Why is it so much harder when it stocks?
Oh, well, I mean, the simple answer is how much does tuna cost? What are we going to say? $5. All right.
You don't do the grocery shopping.
No. But I'm guessing canned tuna, so fresh. Right. Anyway, nonetheless, so if your can of tuna costs $5 and it's on sale for $4, the reason you feel comfortable buying it at $4 is because it actually has that price point, and you know its intrinsic value is $5. The difference with stocks, which is an ownership in an ongoing company, even at the index level, it's just the amalgamation of them all, is there is no, this company is worth $100 and it's on sale at 80, and when the sale's over, it'll be back at 100. There is no certainty in that. And that's the difference between grocery shopping and investing.
You also can't put that stock on your shelf in the pantry either. In
your pantry. No, absolutely. Fair. So that's one aspect. But on the flip side, companies, you know, the vast majority of companies make money, and they find ways to manage even challenging environments of tariffs, and they find ways to make money, and they adjust, and they'll lay people off, and they'll expand in different markets, and they'll do different things to make money because that's what they do. And so with the benefit of this stock versus your can of tuna is if it goes down to 80 and it gets back to 100, it very well might not stop there. And that's why we own stocks.
Absolutely.
Instead of tuna.
Fair. So I guess my final question is, any sense of when we might see some more stability?
Yeah, like honestly, I think we're seeing some now. That was peak tariff uncertainty, I think, in the Rose Garden and following days after that. I think we've got some stability now, not a huge amount, because we keep seeing, I mean, yesterday was a pretty big down day on earnings. And so I think, you know, our mindset was we're probably going to get uncertainty and market weakness around just policy. We thought it would come earlier this year, like January, February, and it waited until now. I think following this, you get some stability in markets, and that could be what we enjoy, and that could last for a while, and it could help markets even recover. I have a hard time envisioning them getting back to sort of their highs, but could certainly continue to recover from here. But then I think the bigger risk is later on this year, if the hard data starts to roll over, you're going to get people talking recession, and that'll probably weigh on markets a second time. But I don't think it's going to devolve into a full-on recession. So I think, you know, this might have been one buying opportunity, but I think there's maybe a bigger one out there. And again, that just is why we have multiple different components within our portfolios that are defensive. And if that opportunity doesn't arise, great. And if it does, then we have sort of dry powder and things that we can do to sort of take advantage of it.
Thank you. I don't see any questions in the Q&A as of yet, but let's maybe give folks a minute or two to see if they want to put some questions in or in the chat. And if not, we'll let you go.
Since I've been doing so many of these, a lot of people have been asking about central bank policy and Bank of Canada, because we just stayed on hold. Totally the right decision. I think the central banks should probably wait until either the dust settles. Mm-hmm. Not that we know when that is, but if it does, that would give better clarity and would give them more clarity on what they should do from a policy perspective. Reacting with a policy to this kind of policy uncertainty from the US is a foolish road to go down. Or if the actual data starts to change, then they can have more clarity on that. So that's been one aspect, and yeah, that's been the only other primary question.
Question
So
you've heard. Okay.
Yeah.